Good morning, everyone. My name is Jason Collins, and I'm with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with the URL, I'd like to personally thank you. We understand that you have many options as to where you place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. Welcome. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers MedSup and Med Advantage products. So please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist with your success. Again, that website is www.urlinsgroup.com. Now, I'm extremely excited to be part of presenting this great program for you today. Single premium life hybrids have been growing in popularity the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no interest in CDs or savings accounts, and have real concerns about their future in regards to long-term care. Today, we're going to discuss a product that will help your clients with these concerns. I'm proud to introduce Jeff Podraza with Nationwide Insurance. Jeff is the Business Development Vice President of Brokerage Life Sales. He's here to review Nationwide's new CareMatters II single premium life product and to discuss how it will benefit your clients. Now, before I turn it over to Jeff, I'd like to mention, should you have any questions during the broadcast, there is a question box on the right side of your screen that you can type them in, and we'll answer at the end of the program. So without further ado, I'd like to turn the program over to Jeff.
All righty. Well, thank you, Jason, and good morning, everyone. And I'd like to thank Jason for the opportunity. For those of you who have, hopefully you can see my screen now. Those of you who have written business with us, I want to thank you as well. Nationwide has been a significant player in the long-term care space, particularly with the hybrid products, in addition to all of the other, guaranteed UL, IUL, VUL, term, etc. But we're going to talk today about CareMatters II, and maybe I will start with a little bit of history in that we came out with our first generation product back about six and a half years ago. And at that point, we were the first to the market with a cash indemnity long-term care solution in the hybrid space. Most of the other products out there, MoneyGuard being the trendsetter, they were first to market. They've got a significant market share in this place, is a reimbursement style solution. We came out with a cash solution, and we've been gradually getting acceptance with the story that a cash solution we think is the most appropriate for the types of care that most people end up going through. Most care starts in the home, provided by a family member. Eventually it may transition to an assisted or a full nursing situation, but that's kind of further on down the tracks. And we feel that a cash solution where we do not require any proof of care, all we need to know is the insured has qualified for a long-term care event, for long-term care coverage, we will start spending out cash benefits. The products way back when were mostly single premium solutions, but what we have seen over time is that they've become more flexible, and with our changes to CareMatters II, which I'll get into in a second, we have really opened up availability of this type of product to a whole new market. So let me jump through the disclosures. I'm sure that Jason will be willing to share these for those of you who want to read it. Some of the things we'll talk about is where we are in the LTC marketplace. Talk about the changes that we made earlier this year to CareMatters. Some of the tax advantages because of a structural change in the CareMatters product for both individuals and business, and a couple of sales ideas. And we'll try and keep this relatively brief. I know that it's a lot of people are crunching toward year end, and we just want to again, introduce this as you're doing your year-end planning, talking with clients about care, to consider Nationwide and the CareMatters II product. As Jason mentioned, the market has shifted. If you go back to the year 2000, you had 750,000 traditional standalone long-term care policies being sold. By 2017, it's now about 10% of that amount. Why is that? Obviously, you've got the use it or lose it objection to traditional standalone long-term care. Most products do not have any type of non-forfeiture arrangement. So if you have a client or a loved one who is in that type of policy, they are basically paying premiums, with the hope of going on claim, which is kind of an odd hope. But the market has shifted between the use it or lose it, and you've seen all the premium increases that have come into play on the early generation LTC policies. People are moving toward hybrids. So by 2017, you've seen that year 2000, there were hardly any hybrids sold. It was a very nascent market at that point. By 2017, you have 260,000 hybrid LTC policy sales, which is now about 84% of the marketplace. So, why do people looking toward these linked benefit or hybrid, or they've also been called asset-based LTC policies? They offer the look and feel of traditional LTC. They have a number of options for inflation, customizing duration of coverage, but they also offer guarantees on premium, and they also, depending on the options you choose, offer a return of premium type feature. So again, as Jason mentioned, people have money in CDs. That's going to be my long-term care money. Why not take that, keep it relatively liquid, and then leverage it for 5.5 times for a long-term care event? And that's what we're seeing. Again, CDs, existing life insurance policies, we're seeing money moving over from qualified funds, and we'll talk about that toward the end. But again, with the other changes we've made in CareMatters, we're seeing more extended pay type situations. Most people don't own LTC coverage, particularly age 65 plus, are not well covered. Again, our recommendation is talk to your clients before they get to age 65, not just with us, but in the industry. The approval rate for long-term care underwriting declines precipitously beyond 65. Less than 10% of this group owns LTC. So LTC is a hot topic. As you're talking with your clients or talking with your friends, there are very few people who have not been touched in some way by a long-term care event. Could be a family member, could be a loved one, could be a neighbor who's had a horror story about long-term care and an unfunded event. Clients perceive LTC as a place, because you mention long-term care to a client, they immediately think nursing home. But as I said earlier, generally long-term care, roughly 70 to 80% of long-term care claims start in the home. They could have care provided by a family member or an informal caregiver. They could have someone coming into the house for a few hours a day as the care event proceeds. And again, very few claims start off with client going straight into an assisted living or a nursing facility. We like to look at long-term care as an event. And people plan for other financial events. They buy life insurance to cover, loans, mortgages, planning for college. People, they plan financially for weddings. They plan financially for their retirement. And frankly, why shouldn't they be planning for long-term care? Because an unfunded long-term care event can really throw a client's retirement plan off the rails in a big hurry. So we like to say that, long-term care, look at the financial impact of it. And if there is an effective way to leverage existing funds to provide that, it's worth looking at. And from the advisor's perspective as well, if you are managing a client's money and they have an unfunded long-term care event, they're going to come to you and say, we need money to provide this care. Let's liquidate some of these assets that you're managing. And, that could happen at a very inopportune time as well. So LTC provides a strong foundation to a client's retirement plan. What we have found, and we've done a number of studies, we have a group called the Nationwide Retirement Institute that does a lot of surveys, client events, presentations, a lot of thought leadership type stuff around long-term care. You find that statistics don't tend to work, because if I say to Jason, Mr. Collins, there's a 70% chance that you are going to require some form of care after age 65, Jason's going to turn to me and say, well, I respect that, Jeff, but I'm going to be in that 30%. So you use a statistic on a healthy male, they're going to say, well, I'm not going to need long-term care, or I'm going to go into the hospital and die 2 days later. That's just the mindset of a lot of people. So we try and shift the conversation away from risk and toward consequences. Don't talk about what the average age of care is. We have tools that talk about the cost, but look at, what are the consequences should you need some form of extended care? What income stream would pay for it? What would happen to the portfolio if you had to liquidate assets in a down market? How would your surviving spouse's lifestyle be affected after draining these assets? And, this is kind of a maybe less financial and more family dynamics, but, will your children work well together in making decisions for your care if you haven't put a plan in place, not just financially, but, what are your wishes for long-term care? What would you like care to look like? In this day and age, times have changed that back in the day, children would grow up, they'd tend to live not too far from mom and dad. They'd be in the same neighborhood or within miles, so it was easy for the children to mobilize in case someone needed some care or someone needed some extra help. Now, particularly with your affluent clients, the children they're better educated, they're going off, they're taking jobs in different cities. We are a much more mobile society. So very often the burden of care is going to fall on the child who, fortunately or unfortunately, lives closest to mom and dad. So a plan with some thoughts and decisions outlined and dedicated funding in place can help ease these concerns. What we have done in going from CareMatters 1 to CareMatters 2 back in May is put in some new features that broaden the market, make it easier for younger people to consider long-term care, and give some broader appeal to that as well. And again, the cornerstone of our long-term care positioning, whether it's CareMatters or whether it's the long-term care rider on our regular life insurance products, is that they are all cash indemnity based. So if the client has a plan of care from the physician says they can't do 2 out of 6 activities of daily living, or they have cognitive impairment that impairs their ability to do these activities without assistance, they qualify for long-term care claim. We don't care what type of care is being provided. We are sending out a cash benefit. The client has a $5,000 a month benefit. We're sending them $5,000. The family does not have to gather receipts for professional care and then send them in every month and have the carrier approve them and then reimburse them for money they've already laid out for care. We think that this gives a much more flexible benefit. Historically, it has been a more expensive benefit, and that stands to reason. But what we're seeing now with changes in the marketplace, we can offer a cash benefit at a price that is very competitive with the top reimbursement solutions out there. So the changes that we've made really fall into these 6 categories: payment options, more flexibility with 1035 exchanges, inflation, refund of premium, retroactive payment on the elimination period, separately identifiable premium. We'll touch on all of these in some detail. How these products work, and if you've worked with us or MoneyGuard or Premier Care or I can't remember the name of Securion's product right now, but any of these hybrids, they all work basically the same way. And again, this illustration is based on a single premium sale. And again, with us and with some of the other carriers, the market is moving more toward the extended pays. But the traditional sale in this space, a client has $100,000. It could be a 1035. It could be a CD. It could be some other funds that are sitting there on the sideline that's their long-term care money. $100,000 goes into one of these policies. It buys a single premium life insurance policy, in this case, with a 2-year benefit specified amount. That's a death benefit of $197. That goes toward funding the first 2 years of long-term care. They choose an extension of benefits. We will go from 2 years up to 7 years. In this example, we're using a 4-year, which is the most popular option. Buys additional long-term care of $394,000. So that $100,000 is leveraged to a 6-year benefit pool of $591,000 of cash. This is for a 55-year-old female non-tobacco couple rating. We also have a residual death benefit. So if the client goes through that entire pool of long-term care money, we guarantee that once they pass on, we're going to pay not less than 20% of that original 197. Again, cash indemnity LTC benefits, 2 to 7 year benefit periods, 5 premium payment schedules, 3 cash value options, 90 calendar day retroactive elimination period. Again, the client can do any of those 5 payment options. The basic structure is still pretty much the same here. Historically, we and most carriers have had a one-time single pay, 5 pay, and a 10 pay. We have added with CareMatters II, up through ages 54, a pay to age 65 option. So for a younger individual who doesn't have a single payment, or even a 5 or a 10 pay, they can do a pay to 65. We can also do up through issue age 65, a pay to 100 option, which is more like your traditional long-term care type solution, your standalone long-term care. You pay a level premium, buys a life insurance amount, a much higher LTC amount, again, with the ability to use inflation options, et cetera. We have improved 1035 exchange opportunities. Our first product was relatively inflexible. The new one allows you to take an existing life insurance policy, do a 1035 exchange into CareMatters II, and then layer in one of these other premium payment schedules if you want to increase the monthly benefit. So it's 1035. Any lump sum amount, we can do a step payment with CareMatters. Target market where the product works best, ages 40 to age 65. We are seeing, and in about 6 months since the product came out, probably about 15% of the cases that are coming in are those longer payment periods, the 2 age 65 and the 2 age 100. And about, again, similar amount, the 15% are actually under age 50, which is traditionally not an age where clients are thinking about long-term care. But more and more, we're hearing of people who say, just went through this with mom and dad. I don't want to put this burden on my kids of having an unfunded potential long-term care event. So they're looking at long-term care at a younger age with a product that they can spread out the premiums, they can get a guaranteed premium, they can get some form of return of cash value. We've added some new inflation options on the product as well, because obviously, particularly younger people, they don't say, give me the highest benefit from day one. It's like, I want the highest benefit at age 80. I don't think I'm going to need to use this for some period of time. We had 3% simple, 5% compound interest on the monthly benefit on the original product. We have now added a 3% compound interest, and which has proven to be the most popular option of the 4 that we have. And we've taken that to another step. So for the same price as the 3% compound interest, we have an inflation option that is tied to the U.S. medical care inflation option. It uses the medical component of the consumer price index and will adjust the benefit each year based on that annual medical component of the CPI. So again, same cost as the 3% compound. We look at the reference index for medical care that goes into the CPI calculation with a floor rate of 0, cap rate of 6. We actually look at it, I said we adjust every year, we actually look at it. We take the rate every year, we adjust the benefit every 3 years and look at, how does it perform based on that 0 or 6, but it will never be less than 2% compound. So the way I like to present this is, for the same price for inflation, you can have a fixed 3% compound, or you can have a compound inflation that's going to be somewhere between 0 and 6%, but will never be less than 2%. So it's between 2 and 6, or a fixed 3. We pre-claim, we adjust every 3 years. Once a client goes on claims, we adjust annually. So it's an interesting option. It is a little bit more complicated to present. We have materials that help explain it, that give some history on the index, but we are the only one in the marketplace that has this. Refund to premium options. Historically, with the single premium products, when they first came out, many of them had 100% return of premium. You move this 100,000 from your CD into your long-term care product, your cash value on day one is $100,000. As the market has evolved, we have seen different options evolve as well. Ones that will maybe start with a lower percentage and then grade up to 100. Well, now we've come up with one that basically says, you're paying for this on a pay to 65 or a pay to 100 basis. The base policy has cash value. If you're not concerned about refund of premium, why put that safety net in there on the refund of premium and just develop more long-term care benefit at the back end? So we have three options. Someone paying a single premium may say, give me the vested option. My cash value is 85% of premium on day one. It will eventually grow to 100% of premium. So it grows from 85 to 100. It's a single pay. It's end of the 5th year, beginning of the 6th year. Same thing for the 5 pay. 10 pay, it actually starts in year 11. Or they can say, I'm not as concerned about getting that higher early cash value. We have a one-time step-up option with the first 10 years. Your cash value is 80% of that refund of premium. Beginning day one of year 11, your cash value is 100% of what you put in. And that gives you more long-term care benefit for the same dollar of premium going in than the vested option. The other new option we've added is a minimum refund of premium, maximum LTC benefit. Remember, you're buying a life insurance policy with a rider. The life insurance policy has a fixed guaranteed cash value to it. But if you choose this minimum refund of premium with maximum LTC, you're going to get significantly more, and we've seen probably on average about 15% more long-term care benefit by giving up that refund of premium option in the early years. And 80% of the cases that we have seen come in the door, and the app counts on this product are increasing significantly month by month as we get more market share here. 80% of the cases are choosing that minimum refund of premium, maximum long-term care benefit. The fact is, in this marketplace, even with single premium cases, the lapse rate is minuscule. It is less than 1 to 2%, because once clients get into these, they recognize the value of them. They keep the policies in force. If the UC surrenders, more often than not, it's within the free look period, because something else is interceded and they've decided, I've changed my mind. I'm just not going to do this at this point. So minimum refund of premium, maximum LTC, the most popular option by far, gives the most long-term care at the back end. Our product has a 90-day elimination period, so that, again, this helps in pricing. It mitigates against short-term claims. The client, they submit their plan of care. The clock starts on the 90 days. We start paying benefits in 90 days. The original product, again, first 90 days are out of pocket. With the new product, once they get through that elimination period, that 90 days, we will go back and retroactively pay the first 3 months benefit and then pick up 4th, 5th month, et cetera, from there. So if you have somebody with a $5,000 a month benefit, they submit their plan of care to us, we approve it, that starts the 90-day window. On day 91, they're going to get a check for the first 3 months benefit plus the 4th month benefit. So they're going to get a check for $20,000 regardless of what type of care has been provided during that period of time. Elimination period, again, is a calendar day, needs to be met only once in a lifetime. This is something, frankly, this is a benefit that, it doesn't really show up on an illustration, but it's the type of thing that we're getting the most positive response on when people learn about it. And the last thing that we've done with the product is basically reconfigured it so you've got separately identifiable premiums for each of the pieces: the life insurance piece, the long-term care rider, the extension of benefits rider, and inflation. And the reason we've done that is because there are some potential tax benefits by having something structured in this fashion. Our previous product, you'd pay a premium, the charges would come out of the cash value, so there was no opportunity for the insured to take a tax deduction or use HSA dollars as they could with traditional long-term care insurance to help offset the cost there. So the client, the first generation product would pay a premium. They'd get a 1099-R each year that didn't generate any tax, but basically told them what portion was paid out of the policy for the long-term care. That would also reduce their basis in the contract. The new product, and it shows in the illustration as you run them, has separately identifiable premiums for each piece. So the LTC, extension of benefits, inflation rider, they each have a separately identifiable premium, and potentially they could be paid out of an HSA, potentially tax deductible for individuals up to age-based limits, which are specified for different age groups, what the maximum is each year that can be deductible or paid from an HSA for a qualified long-term care contract. And there are also tax deduction opportunities for businesses that were not there before. And again, deduction varies based on the structure of the business. We have white papers on this. That getting into all the different weeds here is a little challenging. For individuals, if somebody has medical and long-term care expenses that exceed 10% of their adjusted gross income and out-of-pocket expenses, they can start deducting costs after that for long-term care based on this age-based table you see at the bottom of the screen. So somebody who is between age 51 and 60, they can deduct up to $1,580 a year for qualified long-term care expenses. If they have a health savings account that is funded, there's no 10% floor to meet. They can again use pay up to $1,580 of the long-term care premium if they're in that 51 to 60 age bracket out of their HSA. So there's some tax advantages now with the new structure in this product. We are not the only ones that have this, but we have added it to CareMatters II. Businesses, because of the way this is structured, the LTC portion of premium is a qualified long-term care expense. And where we're seeing this most frequently, and the change in the taxation would be in executive bonus type situations, where historically, if someone bought an employer, again, I've promoted myself to be the president of URL. Jason's a valuable employee. I'm going to say, I'm going to bonus you $10,000 a year for life insurance with an LTC rider, Jason. And Jason's got a tax bill for 10 grand. He says, well, thanks, Jeff. I got to pay tax on this. If I really like them, I double bonus to pay the taxes. But, that's just treated as a life insurance premium. It's treated as compensation, the premium I paid on his behalf. With the CareMatters II product, and again, executive bonus becomes more in play because we have all these extended payment periods. The LTC portion of the premium is deductible by me as the employer. It's not included in Jason's income. Obviously, it must be reasonable compensation, and the LTC benefit that Jason is going to receive will be tax-free per IRS guidelines. So I might pay a $10,000 a year CareMatters premium, and perhaps only about $2,000 or $3,000 of that, the life insurance piece, would be taxable, and the balance would not. It would still be deductible to me as a corporation. It would not be taxable to the employee. That's the typical situation that we're seeing. Again, that's more for a C corporation, employer-employee relationship. There are other pieces in there, and we'd be happy to share the white paper on business planning. We are starting to see folks using IRA distributions to fund CareMatters. I know there's some talk in Congress now of possibly allowing IRA monies to be used on a tax-favored basis to fund long-term care. We are seeing, qualified plans are a large pool of money out there in the marketplace, and many people, particularly the wealthy individuals, say, I don't want to take required minimum distributions. I don't need this money. I'm just going to pass it on to my kids, which is really a bad way to do it because of all of the potential tax traps in transferring qualified funds to the next generation. This particular example, again, Nationwide has got a very competitive SPIA product, and we've got an individual here with a $1 million LTC benefit, $1 million qualified plan. They're going to peel off 10% of that and put it into a IRA SPIA. So they take 401k dollars or other qualified dollars rolled into an IRA. The IRA funds by an IRA SPIA, and we set up a 10-year term certain distribution. The distributions, and we can all do this behind the scenes at Nationwide, 100,000 generates term certain income of 11,000 and change per year. The CareMatters LTC is purchased with a 10-year guaranteed premium schedule. Client pays the tax each year, so they get the most leverage out of that money. And what that does, that 100,000 buys a 6-year benefit of 475,000, 158 of death benefit, policies paid up in 10 years, residual death benefit of 20% of that 158, and it becomes a monthly tax-free LTC benefit of $6,600 a year, or close to $80,000 a year. So again, this is a way of using maybe not a sleeping asset, but an asset that the client was just thinking, I'm not going to use this, I'm going to pass it on. You can get some tax leverage by doing this. Helps protect the portfolio from depletion due to LTC expenses. Tax paid now on distribution rather than as a lump sum if the money is withdrawn or passed on at death. If death occurs prior to the CareMatters policy being paid up, CareMatters death benefit gets paid tax-free to beneficiaries. Any distributions for long-term care expenses up until that point are similarly tax-free. Remaining term certain annuities are paid to the beneficiaries. A lot of places to find funds. Again, with the extended payment periods, this now becomes a substitute for more traditional life insurance plus rider sale. But again, Jason will share the presentation with you, but a number of places to find the money. Typically, this has been a sleeping asset type sale, CDs, bonds, excess liquidity. And again, but now we're seeing more and more cases being sold with the longer payment periods. So, matter of finding the money. So again, just a quick wrap up. I appreciate your time today. I think I've gone a little longer than I anticipated, but once we start talking about CareMatters and we've got some stories to share and statistics on how the policies are being sold, it's part of retirement planning, helps hold the entire plan together because again, an unfunded extended care event can wipe out or seriously derail someone's retirement plan. As Jude would say, it really ties the room together. So the question is not about, will you need LTC and what's the risk of that? It's like, what will happen? What are the consequences if you need long-term care? CareMatters II is one of our LTC solutions that can help fund a plan. Cash indemnity benefits, again, we hang our hat on the cash benefit. We think it's the most appropriate type of benefit for individuals seeking choice and control and flexibility in how care is being provided. Separately identifiable premiums, 5 premium payment options, 4 inflation options, 3 cash value options, the retroactive payment on the elimination period, and again, more choice, control, and flexibility. We have a lot of tools that you guys can use to assist in starting the conversation, showing costs, evaluating, and again, Jason's team is well versed in these and can help you with your CareMatters sale. That's my team. I know Brooke is on the line. Brooke is my regional internal consultant. Brooke and Emily both based out of Columbus, Ohio. I am based out of Philadelphia and work with brokerage general agencies in Eastern Pennsylvania and South Jersey, and we are happy to help you any way we can. So I will turn it back over to Jason. I'm going to catch my breath. I'm thankful the dogs didn't start barking in the background. And again, we're happy to answer any questions that you may have.
Yeah, thanks, Jeff. That's extremely great and informative presentation. You answered a lot of great questions that I had. I specifically like with the new CareMatters, the lump sum, down payment almost, and the retroactive of the elimination period. I think that's just a game changer in the industry. Looks like you did such a good job that nobody really has any questions for you. If any questions do pop up, please feel free to give us a call here at URL for all your single premium life and annuity needs. Should it be brochures, illustrations, or again, answers to any of questions that might pop up. Thank you everyone for joining our presentation today. Our toll-free number is 1-800-926-8875. Again, my name is Jason Collins. I can be reached at extension 156. You can also ask for Joe Corio at extension 111, Maria Adams at extension 102, or Cody Wilbert at extension 136. So again, thanks everybody, and have a wonderful day and happy holidays.
Yep.